Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, February 9th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see futures are higher this morning. We had some really good news, earnings news out last night. We'll go through that a little bit later in the show. But this is definitely some pretty good news that's come out this morning. And last night with earnings, and currently Dow futures up almost 200 points. S&P 500 futures up about 27. NASDAQ futures up 130. So on a percentage basis, again, things are skewed a little bit more toward the NASDAQ. The crude oil prices are up, or excuse me, they're down 30 cents, back down close to $78 a barrel. That's a drop of about 0.4%. And the U.S. 10-year Treasury yield down 4 basis points this morning, back down to 3.59%. I view that as being in a trading range. And again, we'll talk about that in just a little bit. Let's go through the agenda for today. Got a few things I want to talk about. Obviously, start off with the daily market recap. Talking technically, take another look at the S&P 500, see where we sit at this point. Then I'm going to take a look at the absolute price action on sectors. Point out a chart list and how I use one of our chart lists in my trading at Earnings Beats. And then we'll jump into the earnings spotlight, where a number of companies, almost every big company last night beat earnings expectations, some by a wide margin, including Disney. Really good report out of Disney. And then we will wrap up with the three you must see. I'll show you three different kinds of setups, if you will, during the three you must see. So stick around for that. Before we get into any of that, let me take you over to Earnings Beats. For those of you especially that are new to Earnings Beats, if you go to earningsbeats.com, scroll down, we have a free newsletter. That's our Earnings Beats Digest. Name, email address, all it takes. We'll start getting that out to you 3 times a week, Mondays, Wednesdays, and Fridays, all before the close, or excuse me, before the open. I think you'll find it educational. Again, go over to earningsbeats.com, scroll down, and make sure you sign up for that. It is free, no credit card required. You can unsubscribe at any time. All right, so daily market recap. What happened on Wednesday? Dow Jones Industrial Average down 208 points. S&P 500 down 46. NASDAQ down 203. Mid caps down 32. Small caps down 19. Clearly, it was a day of profit taking. It was a day of weakness. Sellers were in control most of the day. Had a couple of periods where the market tried to rally, but really, for the most part, just kept going lower and lower throughout the day. Closing fairly close to the lows of the day, so it was not a rally in the afternoon kind of a day. But it is within the confines of a general uptrend. So even though we've been trending higher, we got very overbought in the short term. I think this is healthy to kind of unwind a little bit. And as stocks have come back down, hit some key support levels, I think you're seeing a little bit of the reaction of that this morning with futures. I think we're seeing some companies that hit key moving averages like the 20-day moving average, turning around, moving back up again today. As far as sectors go, communication services was the worst performer. All 11 sectors were down yesterday. So there really wasn't anywhere to hide. Every sector was down, obviously some more than others. The 3 key aggressive groups were among the top 5 losers. So communication services, which has been on a roll, pulled back 3% yesterday, which is good news. I mean, if you missed out on the breakout and the move to the upside, you're getting a second chance on this pullback. So I like the communication services group. Gap support, the rising 20-day. Those are 2 key areas of support. But anyway, down 3%, a little over 3% in that area. Utilities down 1.7%, and they continue to further decline, which I think's good. I mean, money is coming out of defensive areas and moving into more aggressive areas, and that's what you want to see during an advance. Technology, though, also under some profit-taking pressure yesterday, down about 1.2%. Still in a nice uptrend, still above the breakout level, above that December high. Energy down about 0.9%, around 0.9%. And we had rallied the last couple of days. I see an ascending triangle here. Here's a move up, equal highs, and rising lows. Now, some might look at it and say, well, it's a cup and a handle. Well, the handle to me, the handles come down too far. The cup starts at about 93. You go down to about 82. That's 11. You shouldn't have the handle come down more than about half of that, which would be $5.50, which take you down to about 87.5. We actually went down below 85. So it looks to me like it's the cup and handle pattern kind of broke, but we do still see this equal high rising low pattern, and that is an ascending triangle. A breakout, if we do move back up on energy and we get through $93, this measures up another $11 to about 104, 105. So watch for this pattern to continue to develop. And of course, if we get the breakout, I would expect to see energy participating in any rally going forward. Discretionary stocks down a little less than 1%, about 8.5 of 1%. But this is, again, another group had a strong January, broke out above all these prior highs, right through all that congestion. I think pulling back, you've now got the rising 20-day, which is at 145.43. That comes in pretty close to where these tops were, and that 20-day keeps moving up. I think in the mid to upper 140s, you're going to find really good support in the XLY. If it gets back there, we may simply turn right back around and go to new highs. My guess is we're going to get back there at some point, simply because of options expiration, which is a week from tomorrow. We got a big event coming up on Monday, by the way, on options expiration. I think this could be one of the biggest ones we've ever had, potentially because of the massive move up in many of these growth stocks. I think there are going to be some opportunities, and we'll talk about that more on Monday. If you want to be part of that, you just need to be a trial member at Earnings Beats. So if you go back over to Earnings Beats, that homepage right there, start your no-cost trial. Do need a credit card for that one, so we can get you set up in our system, but there's no charge for 30 days, and we will remind you before your trial period ends that you're going to be charged. So we don't want you to be a member if you don't want to be, but definitely check that out. And so that's basically a quick synopsis of what happened yesterday. Again, not a great day, selling most of the day, but it was on just kind of moderate volume, light to moderate volume, which is fine. I mean, we're not going to go up every day. And pullbacks, light volume pullbacks in an orderly fashion, I have no problems with that whatsoever. 10-year Treasury yield. So I mentioned it was down 4 or 5 basis points. Let's see where we are right now. Down 5 to just under 3.59%. So that takes us down here right to about the 50-day. 50-day is at 3.584, and I'm showing right now 3.59. So we went through the moving averages. Of course, when you're in a period of consolidation, many times it's completely trendless. And one way you see that is when price action, or in this case, yield action, moves up above moving averages and back down below moving averages, back above and then back down below. Moving averages are great support and resistance during trends. But when you have no trend, moving averages do absolutely nothing. I mean, right now, I'm not even really paying attention to the moving averages. I think the keys are the recent lows, 337, and the recent high, about 390. That's what I would be paying attention to right now. As far as economic reports go, later this morning, we will get the initial jobless claims. That's expected to tick up a little bit. I think last week was maybe 182,000, going off of memory. And this week, I believe, as opposed to the consensus estimate, is right around 190,000. So we're expected to jump back up a little bit. But initial jobless claims have been low. And of course, last Friday, when we got the non-farm payrolls out, the unemployment rate was 3.4%, all-time low. 3.4%. I know a lot of folks still looking for a recession. We're not seeing it yet in terms of hiring and jobs. Everybody's looking for employees. They need help. So I don't know, maybe the Fed will get its soft landing that's looking for. That would be nirvana for stocks. If we keep growth going and bring down inflation and rates come back down, that is nirvana for equities. So I wanted to talk a little bit tomorrow. The sentiment numbers come out, consumer sentiment. And so this is the University of Michigan consumer sentiment, just going back the last 10 years. And you can see during, all the way up until COVID, the sentiment held up pretty nicely. I mean, we went all the way up near highs throughout the period. I mean, steadily increasing. And then with the pandemic, we had sentiment go down. Then, of course, we had the big market rally. Sentiment went back up. But right about the time growth stocks began struggling in 2021, it was about the end of the first quarter. Look at the sentiment absolutely fall apart. And this is a pretty decent indicator of a potential recession. And I know the government no longer uses 2 consecutive quarters of negative GDP as the official recession indicator. I actually still like it. I think it makes sense. I mean, if your gross domestic product goes down 2 straight quarters, it's a pretty good indication that things aren't great. This preceded that 2-quarter drop in the GDP, the 2 quarters where we saw negative GDP. Now look what's happening, though. Now we're starting, since right about when I called the market bottom last year in June, since then, consumer sentiment's been going up, straight up. This is normally a really good thing for the stock market. As sentiment improves, usually the market does as well. And now we're seeing that as we break out in this uptrend. This is coinciding with some pretty strong market action over the past few months. Anyhow, I just wanted to point that out. That'll be out tomorrow. And I believe the expectation, let me see if I had that somewhere. Yeah. So the expectation there last month was 64.9. So that's the reading you're seeing right there. So 64.9. That was the January reading. February out tomorrow, expected to go up to 65.1. So we are still expecting a little bit of slight increase. But watch that. If that number comes in higher than expected, I think that just adds to the bullishness that we're seeing so far in 2023. We want to see consumer sentiment continue to pick up. Now, if you go back and you look, I mean, we've had, in 2015, 2016, we were kind of going down. Remember, that was when the market struggled a little bit. Then we went back up again. We had periods where consumer sentiment didn't exactly go with the market, but I kind of like following consumer sentiment just as a secondary indicator. Again, if it goes down tomorrow, I'm not going to say, hey, get out of the market, but I would love to see it come in better than expected. I think that would add to what we've already seen in the market. All right, moving on to talking technically. Not really a whole lot here. I mean, the S&P, like I said, we're just consolidating yesterday. Red candle, filled candle, meaning that we sold off most of the day. I mean, if you want to know what these hollow candles look like relative to a filled candle, pull up an intraday. Let's look at a 5-day, 10-minute chart. So here's your open 2 days ago, and here's your close. So what that candle body is doing is connecting the low and the high, or excuse me, connecting the open and the close. And the tails that you see out the top and the bottom are the intraday highs above the close and the intraday lows beneath the open. So again, if we go back and we look at this candle, there's that hollow candle you closed below the open, and those little tails or wicks or shadows that you see outside the rectangle, that marks intraday low and intraday high. All right. So let's go back again. Let's look at yesterday, because yesterday we opened high and here was the sell-off. Here was a little bit of a rally attempt. We had a couple early in the day. Then we had around lunchtime, a little bit of a rally attempt, went back down and really just kind of closed near the lows. So here's your open. Here's your close, red filled candle. Here's the intraday high, just barely above the open. And here's the low, just a little bit below the close. So you're going to see mostly a filled candle with slight wicks outside. And you can see, you can barely even see them on this daily chart, the little wicks that are coming out the top of the bottom, because mostly we close near, or excuse me, we open near the high and we close near the low. Anyway, S&P 500, I think still fine. We're moving up, little flag. We've taken out prior resistance. I think things are looking pretty good. The rising 20-day has been holding now for a while. We got a nice uptrend in play. I think there's a chance we make a run for 4,300. If we do, between now and say the middle part of next week, I would be really careful if we get to that level or close to that level. I personally will be taking risk off the table because there will be a ton of in the money call premium heading into option expiration Friday and the week that follows. That week that follows can also be a little difficult from time to time. All right, moving on, let's talk sectors. So I pulled up the sector summary for the last month. We know the market, if you look at the S&P 500 over the last month, or if you look at the NASDAQ since early January right here, this is just about 1 month. Look at that move to the upside. I mean, it's been awesome. Hold on one sec. Okay, sorry about that. I mean, this move off the bottom the last month has been really strong on the NASDAQ. And I mean, you can kind of see it, but if I could put like a, go down here and put a rate of change in. And 1 month is roughly about 21, 22 days. But if we just did like 21 days rate of change, I mean, you can see that right now over the last month, we're up 12% on the NASDAQ 100. So looking at the sectors, you can see over the last month here, months must not line up quite right, but you can see over the last month what's been leading. Consumer discretionary, technology, communication services, all three of them, 12, 13%. Next is real estate at 6%. And then not really anything else. So what we're seeing right now is money rotating from just about every other area of the market into discretionary technology and communication services. And let me just ask you a question. When you see a huge rally like this and you see money rotating into discretionary technology and communication services, why in the world would you think the stock market or markets in general are expecting a recession, a deep recession? That makes no sense whatsoever. You would not want to invest in these areas if you thought a deep recession was down the, right around the corner, down the street, right? I get my best news from the action in the market. The market is one of the best leading indicators of what we're going to see down the road. I mean, if we look at, okay, so on a monthly basis, let me click on this, then you can get a drop down of what's been taking place. Auto's up 60%. Travel and tourism up 24% in the last month. Why would Wall Street firms be pouring their money into travel and tourism as we face this big recession ahead? Why? I mean, I'll wait for answers. Probably going to be crickets. I mean, there's no reason. Gambling, recreational services, recreational products, hotels, retail. I mean, it makes no sense. Why would this group, these industry groups, be attracting all this money? Makes no sense. Anyhow, let's move on. Just keep talking. I want to go through some of these sectors and at least get through the aggressive sectors with you and show you their current absolute charts. I talk a lot of times in terms of relative strength, but look at the absolute chart. First of all, notice when we were coming down all this distribution back at the beginning of the year, all these big red filled candles on the way down. Look at, I mean, there really isn't much in the way of selling. We're seeing mostly hollow candles. Even when we have gap downs, we have follow through. I mean, I'm just looking over the last 20, 22 days, whatever that is. I see what might be 3 or 4 not so good days. All the other ones are pretty good days, opening at or above or closing at or above opening prices, resulting in all these hollow candles. I think technology looks great. I think we've moved up and maybe doing a little bit of a flag pattern here off of an uptrend, but we've broken out above key highs. That high around 138, 138.5, that's gone. 5 straight days now we've closed over that. Actually, maybe 6 with that one right there. I think we're making a run for that August high. The XLY, consumer discretionary, also the big move, pulled back. We haven't seen as much upside. There's been a little bit more selling here in discretionary over the past few days, but still well above its rising 20-day moving average, still holding on to support, which was generated when we broke above all this resistance. So broken resistance here becomes support. For me, the analogy is an elevator taking you up different floors. If you start off on the first floor and you push the elevator button and you look up, the ceiling is actually the floor of the second level, right? Well, it's the ceiling. You can't get through the ceiling unless you get on the elevator. And if you get off on the second floor, that prior ceiling becomes your floor. That's basically technical analysis. Very simple explanation of technical analysis. When you break above a key price resistance level where you haven't been able to get through before, you're moving up now to level 2. And when you get off the elevator, now that should become your support area. That's what you're expecting. May not happen, but that's your expectation. Technical analysis helps you forecast the future and expect certain things. Doesn't always happen, and when it doesn't happen, then people say technical analysis doesn't work, of course, which is hogwash. Technical analysis is awesome, but you have to understand going in, nothing is 100%. If you think technical analysis doesn't work, then go back to listening to CNBC and see how that works out for you. Anyway, XLY, I still think looks pretty good. How about XLC? This was the worst sector in 2021 and into 2022. And now all of a sudden, things have changed. This is where you want to be in 2023. I'm convinced of it. Are you going to see some weakness from time to time? Yes. We went down for a year and a half. We saw strength from time to time. But if you chased that strength, if you got in on that strength, you had a hard ride to the downside. I believe we're going to see the opposite in 2023. I believe if you try to short weakness, you're going to be in trouble. Again, just my opinion. I think we have a whole different setup right now in 2023. All right, XLI, industrials. Well, I mean, you've got a nice move here. Obviously, when we get through 104, you're talking about 52-week highs here. So we've got resistance up 103, 104. But again, this one's been doing more sideways consolidating. It had the big run when value-oriented stocks in the fourth quarter had their run. That's when a lot of the industrials ran. This isn't bad. We've just they've passed, they kind of passed the baton on to technology and discretionary and communication services. And so they've taken a back seat and they've consolidated while the others have now taken the lead. That's a bullish rotation. XLF, same thing. Sideways consolidation mostly. We did break out recently, so we are still trending up. This looks a little bit better than the industrials right now. But really, since December, the high in December, we're probably up 2%. Whereas if you look at the high in December for something like the XLC right here, 52, I mean, we're probably up over 10% right now. So you can see that rotation taking place by looking at it that way. All right, moving on. Let's move on and talk about chart list. So this is the strong earnings chart list that I keep at Earnings Beats. And what I've done, there's, 430 companies on here roughly. And what I've done here is I've sorted it based on yesterday's action. And here are what these stocks did yesterday. So we did have some winners, but the market was down. Every sector was down. So to be on this list, it was, a pretty select list. Most stocks went down. But a lot of times what I do is I'll come into this chart list because this is a list of some pretty good fundamental companies. Every stock on this list, every company on this list beat revenue estimates and beat earnings estimates in their last quarter. They cannot get on this list unless they beat both top and bottom line. Many of them raise guidance. They don't have to do that, but many of them raise guidance. Anyhow, what I like to do is I sort it in scooter order. And so this just tells me the stocks that are showing the most relative strength based on the scooter score here at StockCharts. You can look it up StockCharts technical rank in the chart school if you're not familiar with it, but it was developed by John Murphy. It's a relative strength indicator. And here are the highest relative strength ratings according to the scooter of all the stocks on this list. And so sometimes I like to just see, okay, what's been pulling back on some of these really hot stocks that also have strong fundamentals. And another thing I'll do is market's been, if it's been pulling back for a week or so, I'll pull this up in 1 week form. The highest scooter score, Pinduoduo PDD, has been down 10% over the last week. Now, I don't know if that means it's a good candidate for a trade or not, but guess what? It's hitting its 50-day moving average right down near price support. Looks like not a bad opportunity to get into one of the best relative strength stocks. I don't want to chase it at 105. Wouldn't I rather get it when it hits the 50-day at 90? I mean, call me crazy, but I'd rather pay $90 than $105. I mean, who goes out and shops and says, you know what? I know that this suit's on sale, but I'd rather wait until the sale's off. I'd rather pay full price. I don't know that too many people do that. I like to get prices when they pull back, and I think this is an opportunity here. By just looking at this chart list, I mean, we can go down. I mean, all of these stocks are in the upper 90s. These are all stocks that should be considered. All these stocks that have been going down for a week, 3, 5, 7%, take a look at them. Again, I'm a momentum trader. I like to get these stocks when they pull back that are in nice uptrends. All right, moving on, earnings. So earnings spotlight, I just want to go through some companies that had reported last night or this morning and just go through some of the big ones with you and see what they're doing in pre-market. So here's Disney. Let's give you the latest here. It's up almost 6%. They easily beat 99 cents versus 69 cents on their bottom line. O'Reilly, an easy beat here, 837 versus 771 earnings per share. Stock up almost 3%, $23. Sun Life Financial up almost 2%. They beat $1.25 versus $1.16. IFF, this is International Flavors and Fragrances. This one actually is down almost 6%, even though it's posted better than expected earnings, 97 cents versus 94. EFX, this is Equifax. They beat $1.52 versus $1.48. They're down 3%. This is the other thing sometimes doesn't make sense. We had an earnings webinar last night. Actually, it was a sneak preview of our portfolios coming up. And on that, in that webinar, someone asked a question, I think it was ADP, why did ADP come out with great numbers, top and bottom line, beating expectations? Why is it going lower? I think the biggest reason it's going lower is because dividend stocks just haven't been in favor. It's been all growth. So that's probably one thing. But ADP also made a pretty big run and probably is seeing some selling. Equifax has had a huge run. I don't know if they beat revenues, but if they did, this gap down to 213 is getting close to price support near 210. Could be a great opportunity to get in. Anyway, one that missed yesterday was Sterisk. And you can see the stock down 9%. This is one that had been moving up really nicely, down 9% to $196, all the way back to the 50-day moving average. We'll see if that holds. Pepsi reported this morning. So we'll take a look at Pepsi, which is up 1%. I know IPG reported this morning. That one's down about 5.7%. It's had a huge run. Probably is going to be a buy at the open, my guess. I haven't seen their earnings, so I'd like to make sure that they beat. All right, 3 you must see. We're going to do this really quickly. I'm going to start off with Google. Here is a gap up. We've come back down, filled the gap, hit the 20-day moving average. I think that looks good. TRMB, Trimble, respect price resistance until it's no more. Perfect example right here. Got up near that 62 level, right back down $6. As a trader, you want to take profits at key resistance. Final stock, ETN. This is Eaton Corp. I like the breakout here after the recent consolidation. AD line strong. Look at the volume pick up. That's it for me. Everybody have a great day. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.